Imagine for a moment a world where the laws of gravity have been suspended. Not the physical laws that keep our feet on the ground, but the economic laws that have governed human exchange for centuries. Imagine a world where losing money is a sign of strength, where a company with no revenue is worth billions, and where the future is arriving so fast that the past is not just obsolete, it is an anchor to be cut loose. This was the world of the late 1990s. It was a time of filtered sunlight and glass-walled offices, of barefoot billionaires and the hum of server racks breathing life into a new frontier. We called it the new economy. We believed, with a fervor that bordered on the religious, that we had finally conquered the boom and bust cycles of history. But as the sun set on the 20th century, the lights of Silicon Valley weren't just illuminating progress, they were casting long, distorted shadows. We were living in a cathedral of glass, built on the promise of eyeballs and burn rates, unaware that the foundation was already beginning to hairline fracture. This is the story of the dot-com bubble, a period of collective delirium that redefined wealth, destroyed fortunes, and, in its wreckage, laid the literal wires for the world we inhabit today. To understand how a civilization loses its mind, one must look at the soil from which the madness grew. The early 1990s was a period of profound, quiet optimism. The Cold War had ended, the Berlin Wall was a collection of souvenirs, and the information superhighway was a phrase largely confined to the corridors of academia and government research labs. The Internet, in its infancy, was a grey, text-based wasteland. It was the domain of scientists and hobbyists, a silent network of bulletin boards and command-line interfaces. But in 1993, two young men at the University of Illinois changed the visual language of humanity. Mark Andreessen and Eric Bina developed Mosaic. It was the first web browser capable of displaying images in line with text. Suddenly, the web wasn't just data. It was a magazine. It was a storefront. It was a destination. By 1995, the final barrier fell. The National Science Foundation, which had served as the guardian and sponsor of the Internet's backbone, ended its oversight. The keys to the kingdom were handed to the private sector. The commercialization of the digital realm was no longer a possibility. It was an officially sanctioned gold rush. A new orthodoxy began to take hold, preached by economists and journalists who spoke with the certainty of profits. They argued that the business cycle was dead. In this new economy, globalization and technology had permanently tamed inflation. Productivity was finally showing up in the statistics, and for the first time, it seemed the old rules of profit and loss were provincial. The new metric was the network effect. In the physical world, if you buy a telephone, it is useless. If your neighbor buys one, it becomes slightly more useful. If everyone in the world has one, the network is indispensable. The logic followed. Being first was more important than being profitable. If you captured the eyeballs first, if you simply got people to look at your screen, the profit would eventually, inevitably follow like a ghost trailing behind a ship. There were warnings, of course. There are always warnings. In December 1996, a man known for his cryptic, measured speech stood before a podium. Alan Greenspan, the chairman of the Federal Reserve, wondered aloud about the health of the markets. He used a phrase that would echo through the decades: irrational exuberance. He questioned whether unjustified asset values were being baked into the system. The market listened for exactly 1 day. It dipped, shrugged, and then spent the next 4 years sprinting uphill. Greenspan himself eventually succumbed to the atmosphere, backing off his caution and becoming a cheerleader for the very productivity-led growth he had once questioned. The music was playing, and no one wanted to be the first to sit down. Every era has its icons, and the dot-com era chose its saints with care. Foremost among them was Mark Andreessen. The co-creator of Mosaic became the co-founder of Netscape, and soon his face was on the cover of Time magazine. He was pictured barefoot, sitting on a throne, the boy wonder of the new age. He represented the idea that youth and vision were more valuable than experience and grey hair. Then there was Jeff Bezos, a former hedge fund quant with a nervous, booming laugh. Bezos noticed a statistic that web usage was growing at 200-300% per year. He didn't see a toy, he saw a retail juggernaut. He decided to sell books, but his strategy was deeper than paper and ink. He popularized the mantra, "Get Big Fast," or GBF. He told investors up front that he might not be profitable for years. He wasn't building a store. He was building a vacuum that would eventually suck up all of commerce. But the visionaries needed the cheerleaders, the analysts who could translate techno-babble into Wall Street gold. Mary Meeker of Morgan Stanley became known as the Queen of the Net. Her influence was so absolute that a buy recommendation from her could move a stock price by 20% in a single afternoon. She argued that traditional valuation metrics, like the price-to-earnings ratio, were obsolete relics of the industrial age. In her shadow was Henry Blodgett. He rose to superstardom by making a daring bet on Amazon. When the stock was trading at $240, he predicted it would hit $400. Most laughed. Within weeks, the target was met. Blodgett became an oracle. Yet years later, the curtain would be pulled back to reveal private emails in which he referred to the very stocks he was praising in public as pieces of junk or disasters. The machinery was greased by men like John Doerr of Kleiner Perkins, perhaps the most powerful venture capitalist in history. He famously declared that the internet was the greatest legal wealth creation event in history. He wasn't wrong, but the wealth was increasingly becoming of the paper variety. And then there were the enablers of the infrastructure. Frank Quattrone, the king of the tech IPO, revolutionized the spinning of shares, a practice where he would allocate hot new stocks to the personal accounts of executives from companies he wanted to win business from. It was a closed loop of mutual benefit. As the bubble inflated, the lines between visionary and villain began to blur. Bernie Ebbers, a former gym teacher, built WorldCom into a telecom titan through a series of aggressive, debt-fueled acquisitions. He was the man laying the pipes for the new economy. Meanwhile, at Enron, Ken Lay and Jeff Skilling were being hailed as geniuses. Though primarily an energy company, Enron was treated as a tech darling because of its high-speed bandwidth trading desk. They were the smartest guys in the room, or so we were told. To understand how the bubble grew to such precarious heights, we must look at the financial engineering that served as its bellows. In the 1980s, the path to an initial public offering, an IPO, was long and arduous. A company usually needed 5 years of proven profitability before it could ask the public for money. By the late 90s, time had compressed. Companies with zero revenue and no clear path to profit were going public within months of their founding. The process was designed to create a pop. Investment banks would deliberately underprice an IPO so that on the first day of trading, the price would double or triple. This wasn't just about raising money, it was free marketing. It created a frenzy of flipping, where investors would buy in the morning and sell by lunch, pocketing life-changing sums. The scarcity was manufactured. Insiders were bound by lock-up periods, usually 180 days where they were forbidden from selling their shares. This created a thin float, a low supply of available stock. When the public's insatiable demand met this tiny supply, the prices didn't just rise, they shot into the stratosphere. Language itself began to change to accommodate the madness. Traditional accounting, governed by GAAP, generally accepted accounting principles, was seen as too restrictive for the limitless potential of the web. Instead, companies reported pro forma earnings. These were figures that simply ignored inconvenient expenses like interest, taxes, and stock-based compensation. Then there was the burn rate. In any other era of human history, spending money faster than you made it was a sign of impending failure. In 1999, it was a badge of honor. Investors cheered when a company burned through its cash, believing that aggressive spending was the only way to own the market. When revenue didn't exist, they invented it. Through barter advertising, Company A would buy $10 million in ads from Company B, and Company B would buy $10 million in ads from Company A. No cash ever changed hands, but both companies recorded $10 million in revenue on their books. The spreadsheets looked healthy. The reality was hollow. This mania was democratized by the rise of E-Trade and Ameritrade. For the first time, the barricades of Wall Street were down. Suburban parents, college students, and shopkeepers could trade in real time from their home computers. This was the day trader phenomenon. It created a feedback loop where retail, dumb money pushed prices to levels that institutional smart money knew were absurd. But eventually even the professionals gave in to the fear of missing out. If your neighbor was getting rich on a sock puppet company, how could you afford to stay on the sidelines? And beneath the software, a physical bubble was forming. Telecom giants like Global Crossing and WorldCom were laying millions of miles of fiber optic cable under the oceans and through the soil. They operated on the assumption that internet traffic would double every 100 days. They were building a world that didn't yet exist, creating a massive oversupply of dark fiber that would one day crash the entire telecommunications sector. The Big Bang occurred on August 9th, 1995. This was the day Netscape went public. The company had no profit and was essentially giving its product away for free. Yet, the stock, priced at $28, opened at $71 and closed at $58. It was the shot heard round the world. It proved, definitively, that the product didn't matter as much as the promise. By May 1997, Amazon joined the fray, going public at $18 a share. Skeeks called it Amazon.toast, certain that the brick-and-mortar giants like Barnes and Noble would crush this upstart. They underestimated the tenacity of Bezos and the shifting tide of consumer behavior. There was a brief moment of terror in October 1998. The Russian debt crisis and the collapse of the massive hedge fund long-term capital management threatened to freeze the global financial system, but the Federal Reserve stepped in, cutting rates and flooding the market with liquidity. In hindsight, this was the fuel for the final vertical climb. The money had nowhere else to go but into the dot-coms. The year 1999 was a fever dream. In January, a small social networking site called theglobe.com went public. It posted a 606% gain on its first day of trading. In April, Priceline.com followed, making its founder, Jay Walker, a multi-billionaire in a matter of hours. The excess of the summer of 1999 was perhaps best captured by a company called Pixelon.com. They threw a $16 million launch party in Las Vegas called the iBash. It featured The Who, Kiss, and Tony Bennett. The world watched in awe as the founder, a man named Michael Fenn, held court. It was only later discovered that Fenny was actually David Kim Stanley, a fugitive who had been on the run for years. The party was a metaphor for the era, a grand, expensive show put on by a man with a secret. As the year wound down, a shadow loomed. Y2K. The millennium bug threatened to crash every computer on Earth when the clock struck midnight on December 31st. Companies spent billions upgrading their hardware and software to avoid a catastrophe that many feared would end civilization. This created a massive temporary boom in tech sales. We were pulling future demand into the present, creating an artificial peak that would make the eventual fall even harder. On January 10th, 2000, the ultimate symbol of the new economy appeared. AOL, the brash internet service provider, announced it was merging with Time Warner in a $165 billion deal. It was the new media, effectively swallowing the old media. Historically, this is seen as the top. It was the moment the dream reached its maximum volume. Weeks later, on January 30th, the dot-com Super Bowl took place. 17 different internet companies bought ad spots at $2 million per 30 seconds. One of them was Pets.com, whose mascot, a sock puppet dog, seemed to be everywhere. Most of these companies would be bankrupt within a year. They were spending their remaining venture capital on a single night of television, hoping for a miracle that wouldn't come. On March 10th, 2000, the Nasdaq Composite Index hit its all-time high of 5,048.62 points. On the floor of the New York Stock Exchange, traders were reportedly popping champagne. It felt like the party would never end. It ended 3 days later. On March 13th, heavy selling began in Japan and Europe, and quickly spilled into the United States. It wasn't a crash at first, but a leak. On March 20th, Barron's magazine published a haunting cover story titled "Burning Up." It provided a cold, hard list of 51 major internet companies that were on track to run out of cash within the year. The math was finally being done. The decline accelerated in April. A judge ruled that Microsoft was a monopoly, sending the tech giant's stock into a tailspin. Because Microsoft was a cornerstone of the market, it dragged the entire Nasdaq down nearly 8% in a single day. Then came April 14th, 2000, Black Friday. The Nasdaq lost 9% of its value in one session. This was the moment the buy the dip mentality died. For years, every time the market fell, investors jumped in, confident it would rebound. But this time, when they reached for the bottom, they found only air. The year 2001 was a long, slow realization of what had been lost. The Super Bowl, which had been a parade of tech ads just a year prior, featured only 3 dot-com commercials. The silence was deafening. Then the world changed in a way that had nothing to do with the stock market. The terror attacks of September 11, 2001 froze the global economy. When the markets finally reopened, the Nasdaq bottomed out further. The optimism that had fueled the 90s was replaced by a grim, new reality of security and conflict. In December 2001, the new economy suffered another blow. Enron filed for bankruptcy. While it wasn't a dot-com in the traditional sense, its collapse was built on the same creative accounting and hidden debts that had defined the bubble. It destroyed the remaining trust the public had in corporate leadership. The final low came in 2002. In July, WorldCom, the company once seen as the backbone of the Internet's physical structure, revealed that it had hidden nearly $4 billion in expenses. That number would eventually grow to $11 billion. It was the largest bankruptcy in American history to that point. On October 9, 2002, the Nasdaq finally hit its floor, 114.11. It had lost 78% of its value from the peak. In just over 2 years, $5 trillion in market wealth had evaporated into the digital ether. When we speak of $5 trillion, the number is so large it becomes abstract. But the bubble's collapse was a very personal tragedy for millions. There were the janitor millionaires. At companies like Microsoft and Sun Microsystems, the early employees, the secretaries, the security guards, the junior coders had been paid in stock options. By 1999, they were paper millionaires. Stories were common of administrative assistants in Redmond, Washington, pulling up to work in Porsches. When the crash hit, many of these millionaires made a fatal mistake. They held on to their stock, waiting for long-term capital gains tax status. But the tax system had a trap called the Alternative Minimum Tax, or AMT. People were hit with massive tax bills based on the value of the stock at the time they exercised their options, even if the stock was now worthless. People were literally bankrupted by taxes on phantom money, wealth they never actually had in their bank accounts. Then there was the Pets.com sock puppet. It had appeared on Good Morning America. It had its own float in the Macy's Thanksgiving Day Parade. It was a cultural icon. But behind the scenes, the company was losing money on every single bag of dog food it shipped. The shipping costs were higher than the profit margins. Pets.com went from its IPO to total liquidation in just 268 days. The sock puppet, once a symbol of a new way of life, became the ultimate punchline for corporate folly. The day trading cult left a trail of broken lives. Gretchen Morgenson of the New York Times chronicled the stories of ordinary people who had been swept up in the mania. Truck drivers quit their jobs to trade from Starbucks. A group of doctors in Atlanta reportedly stopped seeing patients for 3 hours a day to manage their tech portfolios. When the market turned, they didn't just lose their winnings. They lost their life savings, their homes, and their futures. In New York City, the area known as Silicon Alley became a ghost town. 100,000 new media jobs vanished almost overnight. At companies like Razorfish and DoubleClick, employees were told via mass email to leave the building immediately. There were no severance packages. The iconic Aeron chairs, those $1,000 mesh office chairs that were the status symbol of the era, flooded eBay, selling for pennies on the dollar to anyone who still had cash. In the wake of the destruction, the government scrambled to restore order. The Sarbanes-Oxley Act of 2002 was a direct response to the scandals at Enron and WorldCom. It mandated that CEOs and CFOs personally certify the accuracy of their financial statements. The era of, "I didn't know what the accountants were doing," was over. If they lied, they went to jail. In 2003, the global settlement saw 10 of the largest investment banks pay $1.4 billion to settle charges that they had misled the public with biased research. Henry Blodgett, the star analyst who had called stocks junk in private while rating them a buy in public, was banned from the securities industry for life.